Thanks for joining me this Friday, the 4th of October. I'm Grady Wolf, market analyst with Bell Direct, and this is the weekly market update. It was a week for the commodities with volatility in oil prices, a record high gold price, and iron ore soaring 15% overnight on Thursday in the biggest intraday rise since September 2021. What is driving the commodity price volatility right now? What is the outlook and what does this mean for your portfolio? Well, let's dive straight in. Starting with oil, energy stocks rose 4.28% this week amid escalating tensions in the Middle East, which is the world's largest producing region of oil. Israel Defense Forces said Iran was firing missiles at the country, which prompted further supply concerns out of the region, thus driving the price of oil up over 3% to $70 and 18 cents a barrel on Wednesday. The tale of the oil price volatility has taken many turns this year, especially in recent months, from a strong decline in September amid weak demand out of China before spiking back up again this week on supply concerns. Rising geopolitical tensions leads to supply constraints, and this is occurring at a time that China is likely to recover from a material stimulus announced out of Beijing last week, and this will likely place even higher pressure on the already weakened supply side and will possibly drive up prices of oil, which is the outlook for the commodity over the near term. So how should you approach investing in oil producers? Well, with caution is the short answer given the high spot price volatility. One way to see how an oil producer is likely to fare in FY25 is to analyse the company's hedging strategy, of which many have increased their hedges to oil to avoid potential losses or missed gains through price fluctuations. Woodside has increased its hedging strategy through FY24 and FY25 for exactly this reason, with some oil production hedged to $81 and 20 cents a barrel for FY25. Gold's rally continued this week to outshine the market with tailwinds in place to extend the rally well into the remainder of FY25. Rising geopolitical tensions, central banks buying up bullion, interest rate cuts, global economic uncertainty and undersupply are just some of the drivers of the gold price rally in the current market environment. This has fueled investor appetite for gold-related stocks given their safe haven nature and the ongoing rally, with the price of the precious commodity up 45.7% year on year to $2,653 an ounce. Iron ore ended the week with an 18.47% rise, also in the wake of China's stimulus announced late last week that boosted demand outlook for the metal from the world's largest importer of or consumer of iron ore, which is China. China relaxed rules for home buyers in the region and lowered mortgage rates to prompt a rebound in the dire property sector, which drives the outlook for increased demand of key commodities. The People's Bank of China also cut reserve requirements by 50 basis points and lowered key medium to short-term rates to stimulate borrowing. With the outlook for a sustainable rebound in the price of iron ore throughout the coming months, this bodes well for our big iron ore miners who faced earnings depreciation from subdued iron ore demand and prices in FY24. As a result of the boost in the iron ore price this week, BHP climbed 2.41% over the last 5 trading days. And adding to the China recovery story, local winemakers have felt an extra boost recently amid the removal of tariffs China had on Australian wine exports. Treasury Wine Estates and Endeavour Group have been two beneficiaries of the lifted tariffs, with exports of wine to China expected to contribute significantly to earnings in H1 FY25. Treasury Wine Estates said it expects higher Penfold sales after Chinese tariffs were lifted, while Endeavour's Chapel Hill Winery and Paragon Wine Estates will also reap the rewards of stronger sales in FY25. Now let's look at the markets over this week. Locally, from Monday to Thursday, the ASX 200 rose just 0.02% as a 4.3% surge for energy stocks was weighed down by consumer discretionary and financial stocks, falling 2.7% and 1.6% respectively. Sigma Healthcare led the ASX 200 gains with a 46% rise after the pharmacy operator offered to make court-enforceable undertakings to satisfy the ACCC's concerns over the company's proposed merger with Chemist Warehouse. Mineral Resources rebounded almost 20% this week and A2 Milk rallied 9.6%. On the losing end, Star Entertainment Group fell a further 42% this week, while West Gold Resources and West African Resources lost 11.92% 9.2% and 9.6% respectively this week. On the broader market index, the All Ords rose 0.05% this week as Energy Resources of Australia soared 37.5%, while BrainChip Holdings declined 9.8%. The most traded stocks by Bell Direct clients this week from Monday to Thursday were BHP, Westpac, Rio Tinto and ANZ. Clients also bought into Telstra, Woodside and Mineral Resources while taking profits from Paladin Energy, Wesfarmers and Dexus Convenience Retail REIT. And the most traded ETFs by our clients this week were led by BetaShares Australian Equity Strong Bear Hedge Fund, Vanguard Australian Shares High Yield ETF and BetaShares Global Shares ETF. Now, taking a look at the week ahead on the economic calendar front, we are likely to see investor reactions to NAB business confidence in Australia and Westpac consumer confidence data in Australia out early next week, with the forecast of a raise in business confidence after periods of declines. The RBA meeting minutes are also out on Tuesday, which investors will likely analyse with a fine-tooth comb to determine the rate outlook for the RBA over the coming months. Now, overseas, key US inflation data is out later next week, with the market forecasting a slight decline in the annual inflation rate as the Fed's inflation taming strategy continues to cool inflation in the world's largest economy. And finally, next week, China's trade balance and inflation rate data close out the week next week with forecasts of a decline in both metrics as the world's second largest economy continues to struggle in regaining momentum post-pandemic ahead of that new stimulus announced last week, which everyone is very much looking forward to on a macroeconomic front. And that's all for this Friday. Have a wonderful day, a great long weekend and happy investing.